Welcome to the lecture for Chapter 5. And part of me wishes that we were together for this lecture because I feel super strongly about both of these subjects and I have lots of opinions about them. I think I could actually go on a rant for about an hour on transfer pricing alone. So maybe it's better that we're not together. Maybe it's better that I restrain myself to the format that we've got here where I'm voicing over PowerPoint because, yeah. Anyways, these subjects, the overarching objective of responsibility accounting and transfer pricing, which are related topics you'll see, is how to align the motivations and decision making of managers in a company with the interest of the shareholders in the company. So how do I get a production manager for a manufacturing cell in a factory to think and act like an owner? That's really the purpose of that. And so the whole system of measuring how they did from a financial perspective and then rewarding them based on that measurement, in all cases, it's trying to do our best to align that with what improves the value of the firm overall, because that's what shareholders want. So responsibility accounting is an effort to try to measure the financial performance of subunits within a company. Okay, so it might be the mail room, it might be the marketing department, it might be the HR department, it might be a manufacturing cell in a factory, like I mentioned. Transfer pricing gets into how we charge units within a company for the services or the products that are provided. So if I have a manufacturing division and I have 3 different sales divisions that get their product from the manufacturing division, how do I measure the output of that manufacturing division? And we'll talk about the impact of doing that poorly and that sort of thing. I may go on a little bit of a rant about that, but not much. So the characteristics of responsibility accounting, one of the premises is that detailed information about what's going on in a company is going to increase the closer you get to the activity. So the further down in the organization you go, the greater the level of detailed information. So a supervisor for a manufacturing cell in a manufacturing facility is going to know an awful lot about the scrap rate of the materials that he's using, or the efficiencies of his work, or the quality challenges they have with this supplier versus that supplier, much more than maybe the plant manager would know, and much more than the VP of manufacturing would know, and certainly much more than the CEO. So if we can measure how that person is doing and then reward them based on how they do, we're going to do better allowing them to make decisions there than if the CEO is making decisions about which supplier to use as an example. So along with that knowledge is having decision rights at that level as well. So allowing them to choose which employees do they need or not need, do they make materials or do they buy materials? All of those questions should be done at the lowest level possible, according to this theory. So the performance measurement is obtained from the internal accounting system. So the way we're going to report to them how they did and judge them is going to be something that the accounting system will produce. And from experience, I can tell you that it's very, very important that the person setting up the accounting system, probably the controller, understands the information that needs to be gathered so that they can record those transactions in real time. And sometimes that is having automatic counters on machinery, or there are ways to make it more efficient. And then having a way to capture transactions and report them out very, very efficiently. A lot of times that can be done through the setup of the account numbers in a company. I worked for a company where we switched and had a 12-digit account number. So it was 3 segments of 4 digits each. And so the first 4 digits was the root account number. So it might be sales or cost of goods sold or depreciation or whatever the case was. The middle 4 digits were a product line. So if the cost, like advertising, was associated with a product line, or sales and cost of goods sold was associated with a product line, we could track it by, we had about 10 different product lines. And then we could also look at the last 4 digits were by department. So if I wanted to know what was spending in the mailroom, I could run a report for just the 4 digits in the last segment that pertain to that. So designing the system so that each time you're required to produce information, you're not starting from scratch can help a lot. The last point there is in red because I didn't see it in the book, but I think it's important to mention. And that's that the feedback, the financial reporting that you give to people needs to be very timely. It needs to happen right after month end, within a couple of days of month end. There's many companies that are doing real-time reporting where it's updated every hour and people can look and see immediately how they're doing and what their costs are. You can't talk to somebody in mid-March about how they did in January. That just doesn't work. So here's an overview of how we're going to look at this responsibility accounting. So the lowest level are cost centers. So then in that case, the manager just controls expenses. So maybe it's that supervisor of that accounting or that manufacturing cell. It could be the marketing department, the mail room, HR, whatever you want to look at. So they're not selling anything to anybody, they're just incurring expenses, and that's what they're responsible for. The next level is profit centers, so they're responsible for expenses, but also for revenues, and those might be internal or external revenues. So there's either transfer pricing, which we'll talk about later, for internal revenues, or there's prices that are set to customers for external sales. So that could be a division within a company or a manufacturing facility could be considered a profit center. And then up one more level are investment centers. So they have responsibility for revenues and expenses like the profit center does, but now they also have the ability to make decisions about capital that's spent. Do we need another building? Do we need more computers? Do we need more machinery? Those kinds of things. And they can be judged for whether or not they make good decisions if they buy assets that produce profits. So starting with cost centers, let's talk about both the design and then problems with it, and then we'll move on to the others. So the design, as I mentioned before, it's the manager responsible for that particular cost center that they have an understanding or insight into what the optimal way to do things is. So is it better for them to have a lot of employees or fewer employees and more machinery? Is it better for them to make products versus buy products from suppliers? Is it better to have fewer workers that are better trained but all work overtime, or is it better to have more workers that none of them get overtime? What is the mix there to optimize operations? That means that they also have to have the right to make decisions about those things, about what form of labor they have, what type of sources for materials, supplies, all of those kinds of things. So the book talked about 2 ways of measuring, which I thought was a little bit strange, but I want to mention it. So one is you have fixed output and you have to minimize the cost for that output. The other way is to say you have fixed expenses. You've got 4 people and they can only work 40 hours a week, and I want you to make as many parts as you can. Give me the maximum output for that level of spending. In all the years I've worked in business, I've never been in a situation where you just make as much as you can in terms of output. So I don't quite see that. Usually it's about minimizing the cost for what you're required to do. So some of the problems with that, minimizing average cost doesn't usually maximize profits necessarily because it gives cost centers an incentive to overproduce. I worked in a company once where we had a division that was a sawmill in Eastern Washington, and they were making wood parts for our playground equipment. It was a specialty mill. They only made parts for us. They didn't have any other customers to speak of. And we judged them on their profitability. We established transfer pricing, so we had an income statement for them, and one year they had losses. And a truck showed up in our parking lot one day full of parts and that we hadn't ordered from them. And when I called the manager and asked him about it, he said, well, our losses are because you're not buying enough, so we're just going to start making parts and shipping them to you. So again, that probably seems crazy to you because it's just moving inventory from one part of the company to another part. It's actually, we were worse off because now we increased our inventory unnecessarily. But that's the kind of incentive it can give to a cost center, is to overproduce. So they're spreading their fixed costs over more parts. And then the quality of the parts has to be looked after as well. So you can't just reduce your cost because you've reduced the quality and think that that's done anything good for the company. You don't want to reward managers for that. So the next level is a profit center design. So that now gets into the manager's knowledge about product mix and demand, but pricing as well. And they should be able to make decisions on that. The one thing they can't do is make decisions about their capital budget. So they have the machines, they have the technology that they have, and they're not in a position to ask for more. The way that's usually measured is either were they profitable or not, or were they profitable compared to what we budgeted they would be. So some of the problems with that, we'll talk in the next lecture about transfer pricing. So that's a whole nother subject, but setting the right transfer price can be quite tricky and can have a big influence on internal profit. There can be an argument about how to allocate corporate overhead costs to these profit centers. Again, it can lead to arguments either why am I getting this share of the president's salary on my P&L, my income statement, or if you don't allocate any overhead costs to the center, then they appear to be extremely profitable and start asking for bonuses, and they want their share of their profits and all of that kind of silly talk. The other problem can be that divisions only focus on maximizing their bottom line without regard to how that might affect other divisions within the company. I worked for a company that had multiple different product lines, and each one was set up as a division with a general manager, which I was one, and we had bonuses that were tied in part to our profitability. And I know of stories where multiple divisions would pursue the same potential sale and would discount and compete against each other to win that sale, resulting in the company being less profitable than if they had cooperated with each other. So you can have problems where the overall company is harmed by that kind of activity. The next area is investment center design. So this is now where companies where the department can make decisions about capital. So they not only have to have knowledge about the right way to make product and the price to sell it at and what the demand for it is, but how they can deploy capital spending within their division to improve efficiency and profitability. So they have to have the rights to be able to do that. Different ways to measure that, and I'll talk about each of these. One is return on investment. So rather than just looking at profitability, it looks at profitability relative to the amount that's been invested in that division. If one division has profits of $100,000 and has $500,000 worth of assets, another division has the same $100,000 of profit, but has $2 million of assets. Obviously, one manager is doing a better job than the other manager at utilizing their assets. Another one we'll talk about is residual income, and then I'll last talk about the one I think is the best, which is economic value added. So return on investment is an accounting measurement. So we'd look at the accounting net income for a particular investment center divided by their average assets over the period of the year to say what their return was. It would be expressed as a percentage, like a 10% return. In that example I gave you a minute ago, if they earn $100,000 and they have $500,000 as their average assets, that's a 20% return on investment. So there's something called the DuPont formula, which I think is actually pretty cool. So it shows that the return on investment is the sales turnover times the return on sales. So the sales turnover is the sales divided by the total investment in that division. So how good a job are they doing at taking the assets that they have and creating sales with those assets? And then it's multiplying it by the net income divided by the sales. So how profitable is each sale? So you can see if you laid that out on paper that you could cross out total investments and or rather sales on both, and you would get net income over total investment. So you get the same thing. But the reason I like this better is it focuses on two things you can do to improve your return on investment. One is you could reduce the investment. You could reduce the assets that are required for you to do what you do, meaning bring inventory down to the lowest efficient level possible. Collect on receivables within terms so that you don't have a large amount of receivables. Those are all added to your total assets. Don't have a lot of cash sitting around. Do something productive with it or pay down debt. It can help in that regard. And then net income, obviously divided by sales, that's making sure that the sales are as profitable as they can. But those are two different objectives. The one downside to a return on investment approach is it can cause underinvestment. So if I'm going to be introducing a product line a couple of years from now and it's a fairly complicated product line, maybe I should start building the factory now, start putting machinery in now, that sort of thing. Well, those are all going to be assets that I'm adding to my total investment that are not producing immediate sales or profits. So that's going to hurt my return on investment. So one downside to this is it causes more short-term thinking when long-term thinking might be what's best for the company. Next is residual income. So residual income takes the same accounting income and they subtract what the required rate of return is times the capital that's invested in that investment center. So if our required rate of capital is equal to our weighted average cost of capital, so how much do we pay for debt and how much, what kind of return do we need to offer on our shareholders' equity? So taking a blend of those two based on how the company is financed and saying that we need to do better than that. So if we've invested $1 million in your division and our required rate of return is 15%, then you should produce at least $150,000 worth of profit from that $1 million we've invested, or you're pulling the company down rather than pulling it up. So residual income is going to measure the difference between what you earned and what you should have earned based on the capital that's been invested. So this is a better way to do things. It still has that same downside of encouraging short-term thinking over long-term thinking. So the last one they talk about is economic value added, which I think they save the best for last, and I like this one. So it works very much like residual income, but rather than just taking the accounting income, they make some adjustments to it. And the adjustments they make to it are to try to encourage longer term thinking. And this could be done differently in every single firm, but the objective basically is to try to not punish somebody for long-term work. So our research and development, R&D, is a good example of I spend the money now and I hope it's going to pay off a couple of years from now when I have new products. So it's an example of something that reduces net income today, but is good for the company to do down the road. If we had a system that ignored that, I could be tempted to just eliminate my R&D department and have a bigger bonus, that sort of thing. So they make adjustments. So in this case, normally we would expense research and development as incurred. That's the normal accounting for that. But for internal purposes only, not for external financial reporting, but for internal purposes, I might amortize that R&D over 5 years. So it's going to add to the investment in the firm, but it's not going to affect my profitability. So that's one example of a way to do that. So the economic value added can be increased by 3 ways of doing things. Either I could increase the efficiency of existing operations, so I could either reduce unnecessary investments to bring my investment down. I can obviously operate more profitably, be more efficient. And another way I could do it is I could increase the investment in projects that have a positive spread, so that provide a really good return compared to the cost of capital. And I could de-emphasize or get out of operations where it's less, so I can fine-tune what I'm doing to improve that. And really, if I do that, I'm acting as the shareholders would want me to act. So the last point I want to make, and then I'm going to end this lecture and I'll do the transfer pricing as a separate lecture, is the controllability principle. And that's to only hold managers responsible for the costs and decisions over which they have authority. So that's going to produce a seemingly larger bottom line, but that can be accounted for with how they're compensated. But it's basically, it can be demoralizing if you see things on your profit and loss statement that you can't decide not to do them, or whatever the case is. The problem is that all of these things need to be mitigated with common sense. So just because you're not responsible for the overall building doesn't mean you shouldn't take care of the building, that sort of thing, or plan for different kinds of eventualities like they talk about here. Even though it doesn't maybe factor into the financial equation, it's still what a good manager does. So that's important to keep in mind. So I'll end at this point, and I will pick up again on transfer pricing in the second half of this lecture. Thank you.